Hey guys, I'm gonna give everybody a minute to get in. I'm gonna get these YouTube comments connected so I can see everything. I'm still trying to figure out how to get you guys like the Patreon's comments to pop up kind of the way it pops up on the screen with YouTube, but I'm not sure if it actually does that. So while we kind of wait, if you guys have any questions, kind of like go ahead and put them in the chat. But tonight we're going to get on the Greeks. Something someone asked about in our last live about covering a little bit more of the Greeks. So I'm going to be looking at those tonight, looking at all 5 of them, and how they play a part in the option chain. Well, not the option chain, but your overall option value. So that's what we're going to be on tonight. Yeah, the Greeks on the option chain. So this is what I'm going to do, y'all, because I'm honestly not in the mood to be trying to put in GTA cheat codes, trying to get this screenshot up for Robinhood. So what we're going to do is we're going to use the option chain on TradingView. Okay, so if you have your brokerage account on your phone, you'll be able to go and look at. Actually, I prefer you guys do it that way because I don't think anybody in here is actually trading on TradingView. And so everything we look at on the option chain on TradingView is going to be the same concept and the same thing on the app that you use, whether Robinhood, Webull, Thinkorswim. These concepts are the same, but depending on the platform you're using, you might see some additional things there. But overall, everything that we talk about tonight is pretty much going to be on your platform. Some stuff you may see more or less. It just all depends. SoFi, very straightforward, simple. Robinhood, the same. Webull, you can actually customize what you want your option chain to show you. So regardless of that, long as you understand like these part of the Greeks, then you'll be able to kind of identify it on whatever platform. So that's what I want you guys to do. If you want to follow along in what your platform, what you would do. So before we even get started, regardless of the platform you're using, go to the app. Pick any stock you want, doesn't matter. But if you do want to follow along with whatever one I select, then I'll just show you. I might just look at some that's up there, probably Apple, I think what I was looking at. But go to the stock and hit trade or hit options, whatever that may be in your app. So that way, as we're going through each thing, you can actually go and find and identify it on your app. So you'll know exactly where to find everything that we're going to talk about on the Greeks. Okay. Not only the Greeks, by the way, probably looking at the rest of the option chain, like the bid, the axe, and the spread. I think we did talk about that in the first one. We talked about the bid, the axe, the spread, which is the buyers and the sellers. And then the spread is the difference between the bid and the axe. So if you weren't in last Wednesday's live, then just go watch the previous one, whether you're here on YouTube or if you're in the Patreon. So you'll be able to watch them in either one. So that way we can kind of just focus on this one topic, which is the Greeks, so that I can start showing you guys, those of you who are new to it, how to calculate everything when you're trying to determine the value and how the value of your option kind of changes up before you get into a trade, or even if you're in it and you want to do a little bit of calculation, then you'll be able to do that. So let me see. Let me come back over here. And it's all right. So it's a good bit here now. So we're going to go ahead, get this thing started. Don't want to take up too much of the time tonight. Kind of get this thing in probably about 30 minutes. And that way also, like I said, ask any questions for those of you who are getting in. Just put them in the chat and I'll go back over there and kind of be flipping back and forth. Okay. So the first thing is this. The Greeks are the 5 things that determine, how the value of a option change, regardless of what the strike price is. And one thing you probably always notice is that the strike price is not the strike price, but the details of the option chain changes with every single strike that you select. So, a $15 strike will have some completely different details than a $20 strike. The calls will have something different than on the puts. It just all depends, okay? Depending on, like some strike prices, like on the call side, may have a little bit more volatility. It may have a little bit more demand, a little bit more open interest versus the other side. So you'll see the changes. You'll see the details on that particular strike differ across the board. And so the key thing here with what I'm kind of explaining to you guys would be the exact same thing on the calls and the put side. Okay, you may see it like a negative on puts, and you may not see that negative sign on the call. That doesn't change anything. Okay, just remember, puts, you're playing it to the downside, so it just shows it as a negative, or you may see the minus sign. And then calls, you're playing it to the upside, so you may not see that. Don't let that confuse you. Okay, so let's get over here and go to TradingView. Let me get this option chain up. For those of you who are just coming in, I'm not going to be pulling up Robinhood and doing the screen share. The GTA cheat codes just ain't in me tonight. I don't feel like trying to do it. I was trying to do it before I got on here, but it takes a while. So I want you guys to open up your brokerage accounts on your phones or whatever you may be on so that you can find the Greeks on your end so you'll know where to find them, how to identify it as we go. And just remember, everything over here is the exact same thing and how you will see it in your account. Different setups, of course. Terminology, the exact same. So let me go over here. And can you guys see this good enough? Because I'm from my end, it's not like on the full screen. Okay. So I wanted to make sure you guys can see it. I'm not sure if that's just how it's showing on my end. So let's get this thing going. Now, TradingView option chain can be customized. So I brought this thing down so we can get directly to everything that we want to cover. But I did want to do a quick recap of what we talked about last week. Not a full recap, but mostly the bid, the ask, the spread. Okay, we talked about that as well as the strike price and the volume. All of that was talked about in the very first live. So if you didn't see that one, you can go check that out where we actually went over these things. Now, the bid and the ask are the buyers and the sellers. The spread is just the difference between the bid and the ask. But we talked about having a tight spread is important so that if we get into a trade and we're trying to sell that thing, you ain't trying to be sitting there stuck holding the bag because the spread is so wide, it's making it almost impossible for you to even try to sell it, or at least at the price point that you want. And so sometimes you're going to see some wide spreads, like don't even pay attention to these spreads here on Apple on TradingView. It looks like this, but if you go to the option chain on your phone or your brokerage account, you will notice that a lot of these spreads are not this deep. Okay, so don't want to get too much into that. Go watch the first lesson and you'll be able to get the full rundown on that. Tonight is the Greeks, which is the delta, the theta, the gamma, the vega, and the rho. Those are the 5 Greeks that determines the value and how your option will move. Now, you saw the video. I did some whiteboard lessons for you guys explaining how you use this delta, how you calculate it, and how you can determine the value of your the potential value of your profits before you even made a move on that stock. Okay. This is between the delta and the theta. These are going to be the top 2 important ones, especially if you are a scalper or a day trader, because having a high delta is, it's just a game changer for a scalper for the most part, because what scalpers get into their trades, some of them be in there for a minute, some be for 5 minutes, some might be for 15. Having a high delta kind of lets you know, hey, if I got a high delta, I know that I can hit my profit target in a very little time span. But let's just say you're trying to scalp. You guys notice here on the delta where we got 53 cent, 7 cent, 2 cent, 1 cent. It is probably not going to look like this. And the option chain resets every day, okay? But follow along in your own app. If you got a delta of 2 cents, and the delta, if you're trying to scalp something and you're trying to make, let's just say $200, but you have a 2-cent delta. You will be in that trade all day long, because especially if you're trading something that only gives you a $5 move on the day, maybe not even a $5 move, a $2, $3 move. You will not see your profits on the day trying to trade something with a delta this low. So the higher the delta, the more profits you're going to see. The delta lets you know how much in value your option profits will be per $1 that the stock moves. So if the stock is 150, it goes to 151. You have, let's just say, a 50-cent delta. You're going to make $50 in profit for every single dollar. Now, how do you calculate that? One option contract equals 100 shares. So you notice how right here, if with this bid and this ask, you're seeing $1. I mean, you're seeing $1.80. You're seeing $4.25. That doesn't mean that's how much you're going to pay to get into that trade. You have to multiply it times 100, which is those 100 shares that is inside of that 100, that contract, the option contract. Therefore, you're going to multiply the delta times that same 100, and that'll let you know how much in value you're going to get for every $1. So if you got a 93-cent delta and you catch a $1 move, and let's just say 15 minutes on Apple, you just made $93 on that trade. And whatever time span that you caught that $1, you get $93. You have here 53 cents. You will get $53 for every $1 move that you catch. That is one of the reasons why having multiple contracts is even better. Because if one contract equals 100 shares, 2 contracts equals 200 shares. 5 contracts equals 500 shares. So how many other contracts you have, you will multiply that times whatever that delta is. And that will tell you instantly what your estimated profits will be. But it's not written in stone though, because the value of the delta changes, especially if it's going your way or if the trade is going against you. You will see the value of that delta changing big time. Okay. And especially, I mean, if it's going against you like really bad, then that's a good chance. Like you may have a 50-cent delta, and let's just say that thing drops $4, $5, $6 and you're still in the trade. You might notice that your delta is losing value by, let's just say, 10 cents, 20 cents. And when it's all said and done, you're going to notice you probably have a very low end delta, probably 2 cents, probably 1 cent. What changes that? That would be the gamma. The gamma lets you know how much in value that delta will change for every $1 move that the stock makes. So if you've ever been in a trade and you said, okay, I estimated that I'm gonna make about $50 for every $1 move that I catch. And let's just say you catch a $2 move. For that first dollar, and let's just say the gamma was, let's say, 5 cents. For the first $1 move that you caught on that thing, you got $50 in profit. Hypothetically, it's not always that to be exact. But then by the time you got to that second, you may think, oh, well, I got about $100. But you may notice you may have 105, 110, a little bit more than you estimated. And you go back and look at your trade detail, you just might notice that you now have a higher delta. It might be sitting at about 55 cents now. Why? Because the gamma will let you know exactly what that value is going to be every time the trade continues to move by $1, the same way. Okay. You are able to kind of calculate ahead of time your potential profit, also calculate the value in which it's going to move to say, all right, I catch $1, then let's just say I catch $2. This could potentially be my new delta. So this would actually be my profit. You can keep it simple and just kind of multiply it based on what that delta is in that moment. But of course, if you go over and look at the gamma, you can kind of factor that in if you want to get technical with it. But a lot of times you really don't. You just want to be sure that that delta is enough to be able to meet whatever profit goals you have. And with the gamma, it's just, hey, it's not a huge one to look at all. It's mostly the delta and the theta. But you can at least use that gamma to kind of calculate certain things along the way. You're catching a $2, $3, $4, $5 move. Just keep adding to it a bit. And a lot of times you can't go too far with the adding because the gamma also changes a bit too. So either way, you're just kind of looking at that. You can probably add that first set or that gamma to that theta, not theta, the delta, and then just kind of leave it at that. So the delta lets you know how much in value you're going to receive or how much profit you're going to receive per dollar. The gamma lets you know how much in value the delta will change per dollar that the stock moves. Okay. And you don't have to multiply the gamma by 100. That's another what someone was asking about. And I remember in the messages, he was saying he was multiplying everything times 100. You don't have to multiply that gamma by 100. Only the delta and the theta are multiplied times those 100 shares in that option contract. Okay, so the delta, we got that. And then that gamma is what lets you know what changes that delta. All right, you multiply your delta by 100 shares. So that way, that lets you know exactly what that number is. So you're seeing cents here, but you multiply it by 100, then that thing turns to a couple of dollars, tens or 20s. It turns to hundreds or thousands once you multiply it by that 100. Like this $13.70 here on this 285 strike on Apple would be $1,370 to enter into that trade. Okay, so those for those of you who weren't in that first one, you have to multiply the bid and the X by 100 to determine how much it's going to be for you to actually get into that trade. Okay, now the theta. This is the next most important one. Do not even worry about these thetas that we're seeing here on TradingView right now. If you're on your phone, if you're looking at your particular platform, look at those thetas. Because this here is saying a negative 1,167. No, that's just how this thing is set up over here on TradingView. Now, the theta is your time decay. The time decay lets you know how much in value your option will lose the longer you hold it. So to put it into the simplest, you ever notice that if you're in a trade, let's just say you're up $500 in profit, but you don't want to get out, and you say, okay, I'm going to let this thing run, see if it continues to go up. It doesn't. It reverses and it comes back down. And now let's just say you're sitting at $250. You just lost 50% value of that 500 that you were originally up. Now it goes back up to where it was when you had those $500 in profit. Now it's only sitting at like 400. You got a whole $100 that's not showing up there. There ain't no glitch. Ain't nobody stealing nothing. What's happening is you allow that theta to eat away at your trade. The theta burns away at your premium. It burns away at the value. The longer you hold it, as well as if that trade goes against you and it starts to go down, going back in the opposite direction, the theta is eating away at the value. So even if it goes back up to a certain point where you had a certain level of profit, you won't see that same profit. And listen, that's notorious on Tesla, on TSLL, on SPY, QQQ. Extremely high volatility stocks tend to have high theta, meaning that it's going to eat away if you overstay your welcome or if you just sit there in a losing trade hoping it goes back up, hoping it goes back down, whichever direction that you're playing in your trade. And it goes back, but then you don't see nearly the same profits that you had the first time it was up there. Time decay, the theta, it eats away. Now with this one, you do indeed multiply that times 100. Okay, so you got, I can't even go by that right there. If you, whatever you see on your option chain on your phone, if you're looking at it, that is the, look at that theta, look at that delta, because this over here on TradingView, us multiplying 100 times that 1,000 is highly unnecessary. So you might see delta sitting at like on Tesla SPY like at $1, sometimes maybe $2. On the low end, you're going to see them at like 5 cents, maybe 10 cents, 20 cents, whatever that theta is, you just multiply it times 100 and that lets you know how much value that your option has the potential to lose. You want to see a low theta. You won't always see that, but you want to see a low theta at all times, or as low as possible, especially depending on what your game plan is and how long you plan on being in your trade. So when you look at the theta, I will say this. We know that, as we talked about in the first lesson, the further out we go on our expiration, right? What are we doing? We're buying more time. And when you buy more time, that equals the theta getting lower and lower and lower. Because you have so much time on this trade, there's no reason for this theta to be super, super high, because that's literally what that Greek is. It's a time Greek. And so if you want to get a lower theta, you have to go and get a expiration that's a little bit further out. If this is, what's today, the 13th? Friday is what, the 15th. If you get into a trade with a 15th expiration, you will notice that the theta is going to be extremely high versus one that expires on May 22nd, which is next Friday. So the more time you're adding on, the lesser that theta is going to be. So if you want to get it lower, if you don't want to play it too close to where you got this extremely high theta, go further out on the option chain, unless you got some sort of game plan for getting out of that thing once you hit whatever target you have or whatever you're aiming for. Okay, so that Greek is super, super important. Okay, you need to consider the theta in your trade planning, especially if it's short term. Day trade, something maybe a day or two, or something that's about to expire on a upcoming Friday. And let's just say we're already in Wednesday. Consider the theta in your game plans so that you know that, all right, if it's going against me, or if it just sits still and getting closer to expiration, I already have in my mind that this theta could eat away at my trade if I hold too long or if I let this thing go too far against me. Okay, so that delta and them thetas, them the two most important ones that you want to consider. The two easiest ones to remember as well, but you definitely want to consider them at every single trade. Now on a delta, I will say this: I don't trade with anything less than a 50-cent delta. Okay, I always have a profit target in mind, and I know that if I go too far out of the money and I'm getting something with a lower delta, it's going to take longer for me to see profit, or it's going to take me having to catch an even massive move to even hit whatever target that I have. So I like to stick with a 50-cent minimum on that delta and just let that thing go from there. Okay, so we got our delta, we got our theta, and we got our gamma. Now let's look at the vega. Vega is a volatility. It's more of a volatility measure. And basically with this one, it just lets you know for every 1% that a stock's volatility change, the value of your option can change with that. So if the volatility changes by, let's say, about 10 cents for every 1%. For if a volatility is sitting at about 30%, and let's just say it goes to 31%, the value of your option will increase by 10 cents. Okay. If it's a 10, if you see 0.10, and you'll see that volatility is sitting at about 30%, it moves to 31, then that right there will increase the value of your option by 10 cents. Okay, that's not a huge one that you would look at, but you can definitely look at it, especially when you're trading things that does have high volatility. SPY. Well, let's just say this. Honestly, most of Mag 7 has some decent volatility, but SPY, Tesla, let's see, Eli Lilly, Booking Holdings was one, but Booking Holdings has had their stock split, so it ain't really hitting like it used to in terms of the size move. We're talking about $200, $300, $400 moves on a day with Booking Holdings. Extreme volatility. That right there is not going to do that anymore. But you look at something like Meta as well. MU is another. Look at these stocks that gives you these really big moves on the day, and that has these extreme price swings. That right there is volatility across the board. And so that Vega just lets you know how much in value is going to change as that volatility increases and decreases. Okay, so row is not like a heavy one. If you are a leap trader, I'm primarily a swing trader and a leap trader. The row is one of the ones that would really be one that if you're going to be holding your trades for 6 months or you're going to be holding it on into a new year, The row has to do with interest rates, and it lets you know how much in value your option will change based on the change in interest rate. And because interest rates isn't something that we just get every single day and happens over time, the row is the thing that we really look at for extended periods of time on our expirations. Okay, this is what May 2026. So if I got into a trade for May 2027, then I may be looking at the row to kind of see what that's looking like. But you will rarely see the row change unless there's some drastic change in interest rates. Okay, so there's not really one that will play a huge part in your trade unless it's over time and it's, we see some interest rate change that could really cut into what we got going on, then okay. But it's not one that we really look at when you're day trading, or if you're just doing some short-term stuff. That right there is the leaps and the swing trader Greek. Okay, so it's fairly simple to remember in my opinion. You just kind of have to get it down, but you don't have to overcomplicate the whole thing or confuse yourself. Stick with the delta and the theta. Those are your primary two that you want to look at when you're looking at those short-term trades. Okay, so to kind of go back over that real quick, delta, you multiply times 100. It lets you know how much in value your option is going to change for every $1. Okay, so if you got 53 cents, you catch a $1 move on whatever stock, you just got yourself approximately $53 in profit. Plain and simple. Now, you got your theta. The theta lets you know how much in value your option is going to lose per dollar that the stock moves. All right, that's a time decay Greek. All right, now you got your gamma. Your gamma lets you know how much in value the delta is going to change per dollar that the stock moves. Okay, so you can look at your gamma and say, I like this. If you got like let's just say you got a 20-cent gamma and you catch a dollar move and you already got like a 50-cent delta. If you catch a dollar move, this thing is continuing to go on your way and your gamma is increasing your delta is increasing by 20 cents or $20. Now you send up $70 on that next move or two that you catch, just giving you more and more profit. So that allows you to look at that and say, all right, I got a general idea of what my value change may look like and how much more profits I could potentially make. Okay, so that gamma will look different across the board. You just kind of go look. Sometimes a few cents, sometimes maybe 1 cent, sometimes it may be 15, 20 cents. It just depends. Okay, and so your Vega volatility measure, that right there, and it also lets you know to expect large price swings in terms of, okay, if earnings is coming up or some big event is coming up, you may notice that the Vega is spiking. And so with a spike Vega, that may say, let me go and look at this really quickly. Or an extremely high Vega to make sure there's nothing coming up that I want to kind of take into consideration before I get into my trade, okay? That could be earnings, that could be delivery reports, that could be some sort of acquisition news, anything, some bankruptcy news, whatever it may be. That Vegas, kind of sitting up will definitely let you know that maybe you need to go and check on some things real quick, okay? It's all set at zero here right now. On this May 13th, let's come down to 0 DCE. And let's see here. And you notice it's sitting at about 14, 11, 9, 7. So it's not too heavy right now. But if you ever come over here and look at one when earnings is coming up, you may notice that Vega is spiking high, or it's pretty high. Or if you go further out on your expiration, you will also notice that the Vega is getting high. Why is that? Because over time, within 16 days, what are you expecting? A decent size move on Apple. You're expecting a big enough move that really compensates you holding this thing all the way to May 29th or within 16 days, okay? So you definitely want to kind of pay attention to that. But if that thing is really, really high, and I'm talking about really high, head on over to that news for the stock you're looking and go and say, okay, let me see what this thing is looking at right now. Let me see why it's looking like that right now. So let's come a little bit further out to around, let's see, that's July 17th. And you notice how we're sitting at about 50 on that Vega, 49, it's higher. That's not exactly something to be scared of. The thing is, if you see a Vega spiked up or sitting that high up on something that expires within like a couple of days, then that's when you want to go and look. Because within a couple of days, and I'm not expecting this massive price swing to be happening, this is where you want to go and see what is being anticipated that the Vega is sitting up that's high like this for a short window trade. Okay, so that's all that is. And you will see it higher the further out you go on the expiration date, because you are, if I go wait out to July, I'm probably expecting a $30, $40 move from Apple. Not Apple, but just in general, okay? I'm expecting a big move. So that's just something to kind of, take into consideration. All right. Now, the role, as I said, is dealing with interest rates. And it's just letting you know how that value is going to change as interest rates change. Okay. And this is not something that is huge that you need to really be looking at if you are doing something really short term, like a 0 DTE, 2 DTE, even something that expires at the end of this month. You aren't really looking at that as a huge deal, because you're going to be out of that trade within a short period of time. So you're not really looking at what's going to be happening in 3, 6, 12 months from now based on the particular position that you may be in a short span. Okay, so those are the Greeks. Those are how the Greeks play into your option value. Okay, that is how you are able to kind of do a little bit of calculating before you make a move on your trade. And the only thing, like I said, with the delta and the theta, when you are picking out a strike price, and if you have a profit target in mind, take into consideration what your delta is. Will your delta help you meet this goal that you have for this trade in whatever time span that you're looking to have it? If you say, I want to be out of my trade by the end of the day, and you say, I want to make $100 on this trade, you know that if you pick something with a 53-cent delta, you're going to need to at least catch a $2 move on that stock to be able to see your profit goal. Okay, because that's a $2 move. You got 50 cent plus 50, well, 53. You got what, $106. That's how you need to do it. Okay, you want to be sure that which strike you're picking, that your delta actually matches whatever your profit goal is. So it ain't no surprises when you catch a $2 move and you only got $24 in profit. And you go back and look at that delta, because you only had a 12 cent on the delta. Okay, so take a look at those things. Don't ignore. I know it seems like it's a lot of numbers, but it's not very hard to actually calculate. Okay, just multiply times 100 or times how many contracts that you may have. Okay, you got 500 contracts, you need to multiply that delta by 500. You'll also multiply your theta by the same amount, because it's just kind of letting you know how much it's going to be burning away. Okay, so always take that into consideration as you go, and be sure that those deltas match your game plan, and make sure that the theta isn't going to cut into what your game plan is because of how easily it's going to burn. If you have some drawdown, how much of that option premium is going to be ate away by your theta? Kind of take that. If you got to go and get a higher expiration date, do that so that you can bring your theta down, just in case you have even the slightest of uncertainty on how you want to go about your trade. Okay, so that was that. Those are the Greeks: the delta, theta, gamma, vega, and rho. These are your Greeks that helps you determine the value, determine what the potential loss could be on your trade. And you're able to do these things ahead of time. But like I said, it's not written in stone. So those numbers change. You may have 50 cent, that thing may go against you a little bit. That theta may come, not theta, but your delta may come down a bit. And then now you may see it going back up, but now your profits are getting lower. That's also because it ate away at it, and the gamma is kind of lowering that delta. So the profits are lowering. So keep that all in mind. Keep that all in mind. Okay. So with that, use these. Go to your platforms, whatever platform you may be using. I'm going to go over here to Robinhood really quickly on my phone. And when you go to Robinhood, you pick whatever option that you want or whatever stock that you want. Once you click that stop, just go to trade, hit trade options, and this is for those who are new to it. Go there, and then you will select whatever the expiration you want. And once you get to that chain, just click on any strike price you want, and you will notice that the Greeks will be showing. It shows right at the bottom. It shows the Greeks. Okay, I just hit GameStop $22.50 call. It expires on May 22nd. It has a 42-cent delta, a 23-cent gamma, a 3-cent theta, which is really nice, where you don't have to worry about too much burn, because GameStop is a very low volatility stock. It's very a slow burning stock. So you don't have to worry about these massive price swings happening. So the theta is low and the vega is low, and the row is not even 1 cent. Okay, so you can do that. Just kind of go across the board, look at different strike prices, look at how those options trade, like the option values and those groups actually change when you kind of go clicking through various ones. Okay, and also what plays a huge role, which is what we'll be talking about next week, is in the money, at the money, out of the money, deep in the money, or deep out of the money, or just far out of the money. We're going to be talking about that in our third lesson, because that will also play back to your Greeks and also your value. You're going to be paying more for one in one direction. You're going to pay less. You're going to have a higher delta, a lower delta, maybe have a higher theta. It all connects, okay? It all connects. So we're going to be talking about that on next week, but each lesson is kind of giving it to you guys to where you can kind of combine them all, okay? So last week was some of the basics. You can go check that out. Tonight was the Greeks, and next week will be the moneyness. Okay, yes, money and NES, moneyness, which is in the money, at the money, out of the money, and so forth. All right. So let me come back over here. Let me see. I didn't know that about the delta. I thought it had to do with the change of the stock price. So yeah, the stock price does change it, but I guess you're saying like the value of the option changing. Yeah, of course, the stock price does play a role into the option changing, but that delta is letting you know why it's changing at that amount. Like, why am I seeing 50 cents or $50 in profit right now? Why am I seeing $100? And if you go to your option chain and you see you got a 50-cent delta, and you realize that you've caught a $2 move, that delta is letting you know why you may have $100 in profit, why you may have 50. Okay, so yeah, the value of the stock moving is what affects that delta and what helps it increase and what brings you your profits on that. Okay, let me kind of go back. Let's see. Let me see. This was helpful. What do you think is a good theta? Um, Honestly, anything low, to be honest with you. That's why I was saying, like, taking into consideration, you know, how long you're going to be into that trade and how long you're going to be holding, take into consideration possible drawdown. But honestly, listen, a theta of 1 cent, 3 cent, 5 cent, maybe 10 cent, these low thetas are just super important overall. Okay. I can't really say what's a good theta, because depending on what type of trader you are, what type of trading you're doing, and what the game plan is in terms of how long you plan on being in it, that will determine what's a good theta. If I'm in if I'm in a trade, let's just say hypothetically I get into a trade with a 6 month expiration, and I picked a 6 month expiration, and that theta is saying that it's around $1 or $2. I don't really think you're gonna see that too often, but if that happens, it's gonna be a solid no. Because if I'm looking to hold my trade that long and a theta that high, I am most definitely expecting some drawdown to happen over the course of 6 months. So I don't want something eating away at my option that I'm holding this long. Okay. So it's not really about what's a good theta. It's just mostly about what's a good theta for your plan. If I'm day trading or scalping, I'm already expecting some high theta. So I know I got to be in and out of that thing before too much drawdown happens, before any reversals happen, or before, of course, that thing is about to expire. So that's the biggest thing. So it's not really what's a good theta, but just know a high theta needs some additional planning. A low theta, you can kind of calm nerves a bit to say, okay, I ain't got to worry about it eating away too much at my trade the longer that I hold this thing out. Okay. So that's all that is. I hope that makes sense. Let me come back. Let me see. Let me go back. Oh, you're talking about the red numbers. What is the red numbers? Are you talking about where it says 0 DTE, 2 DTE, 5 DTE? I think that's what you are asking me. Okay, so that's yeah. So that means 0 DTE is 0 days till expiration. 2 DTE means 2 days till expiration, and at 3 DTE, 3 days to expiration. That's all. And all of them is just like 6 DTE, 16 days to expiration. The reason those are in red is just because they expire soon. That's all. But DTE means days till expiration. And you may hear scalpers say, I only trade 0 DTE. These options are cheaper to get into because they expire the same day. Most scalpers use that so they can get cheaper options. And of course, they're going to be in and out of their trade. So they're not really worried about anything that expires later. So that's all that is. Just telling you the time till it expires. And 0 DTE expires the same day that you open it. Okay. And also 0 DTE has higher thetas than versus if you go to like a 5 or a 10 DTE or just further, 0 DTE will most definitely have high thetas on them. Okay. And they're cheaper though. They are cheaper. Most people like 0 DTE because it's cheap to get into. But depending on what your game plan is, don't play like that now. Give yourself some time on that expiration to let it do its thing so that you're not just getting a 0 DTE because it's cheap, knowing it doesn't match your game plan for how long you probably need to be in that trade to allow it to kind of do its thing. Okay. It's depending on what you're trading, to be honest with you. Like I wouldn't do nothing 0 DTE on something like SoFi or something like AMC or Beyond Meats, like them really cheap stock that we think the stock is cheap, the premiums are cheap. Absolutely not. Not a 0 DTE on something that's only moving 5 to 7 cents on a day. Maybe not even that much. Don't play yourself like that. Let me scroll down. Where's my mouse? So the gamma, yeah. So the gamma, you don't multiply that times 100. You just look. You only multiply the delta and the theta by 100. The contract value, yeah. So five contracts equals 500 shares. If one option trade contract equals 100 shares, and you get 5 contracts, you now have 500 shares. So for every $1 move, if hypothetically, let's just say you got a 93-cent delta, okay? If you have a 93-cent delta, that's going to be approximately $93 that you're going to catch per dollar you move. Now, if you only catch $1 move and you got 5 contracts, you want to multiply that 93, let me go 0.93 times 500, and you're going to make $465 in profit just catching a $1 move. Now, here's the thing with that. You likely are going to have to be in the money or deep in the money to see a 93-cent delta. You see a 93-cent delta, you got 5 contracts, you catch $1 move, you could be done. You shouldn't even have to just be sitting there in your trade because 5 contracts with that type of delta will give you $465 just sitting there for that stock to make a $1 move. Now, how long it takes to make his $1 move, we don't know. But let's just say it's something like Tesla. That's why I say Tesla is the stock that makes millionaires. If you can catch a $5 to $7 move on a day-to-day basis with Tesla with something like a 93-cent delta, or even lesser than that, it doesn't matter, 75 cents, 50 cents, you can make some life-changing money on a day-to-day basis that you actually win that trade. Okay, so 93 cents, 5 contracts, 500 shares, would be $465 on just $1 move. Okay. If you caught a $2 move with 5 contracts with that type of delta, 465 times 2, that's $930 you just made on a $2 move from 5 contracts with a 93-cent delta. Whatever your delta is, that is the exact same way. You got a 0.50-cent delta. You got 5 contracts. You're going to do times 500. That's going to be $250 that you're going to make for every $1 move that you catch. Okay, $250 for every $1 move with 5 contracts. The more contracts you get, of course, is going to be more expensive. Absolutely. I think someone just asked me, does it cost more money? Yeah, there it is. It definitely costs more money. With more contracts, you're doubling up how much it costs. So let's just say the particular premium or strike price that you pick, it costs you $115 to get in. You're going to do 115 times 5, and it's going to cost you $575 to enter that trade. Okay, so the more contracts, the more it's going to cost. You got 1 contract, it will only cost you $115. You got 2 contracts, it's going to cost you $230. How many other contracts you have, that's the number you need to multiply times that premium cost. So yeah, it will definitely cost more money to get into to do that. So and it can definitely, I'm gonna say it could be simple in terms of actually getting into those trades, especially when you get into it in a good spot and getting out when you know that you should. If I make $465 and I just call a $1 move and I only got 1 contract, baby, I'm taking that money and I'm going. You can easily find something and rinse and repeat. You don't have to just sit there trying to catch more. I mean, if you want to, hey, that's up to you. But for me, $465 made on a $1 move catch. Let's just say hypothetically, I'm sitting there trade for 30 minutes. I just made $465 in 30 minutes. I'm not finna overdo it. Not one bit. So whatever your profit target is, stick to it. Once you hit that thing, come out. If you got multiple contracts, then of course you can definitely leave runners on that. How many contracts do you recommend? Honestly, there's no recommendation. Okay, you know what? I'll take that back. I do recommend having that minimum too. Not when you're just starting out. I know sometimes you want to get your feet wet. I don't want to tell you overdo nothing now. But I do recommend having a minimum of 2 because this allows you to take profit once it hits one target, or just take profit when you're satisfied with what you're seeing and leave yourself that runner to kind of go to the next target. Or if this thing starts breaking key levels and is going the direction you want, then you got a runner to leave to actually let that thing go. Okay, so I'll be honest. I say start with 1. Start with where you're comfortable, but I do genuinely recommend have 2 as you kind of get better at it and get more comfortable, so that you can take profit and leave runners, so you're not just kind of missing out on move. Don't think about it like that, but you can definitely leave a runner if you did have multiple contracts. It is one way to maximize your profits in option trading. Okay, but me, for the most part, I have a minimum of 3, unless it's like a super expensive trade. I may do 2, or if I do 1, I'm likely going to be out of that trade once I hit 30% in profit and I close it out. That's mostly when I'm doing a day trade, but I primarily hold my trades. So if I ever got 1, I'm likely coming out the same day. Why do you only do a 50-cent delta? Because I mean, that's just my minimum. That's not saying that's the only one I pick. That's just the minimum that I trade with. So if I'm picking my strike price, I want to see a minimum of $50 in profit per dollar in whatever direction that I'm playing. So I'm not saying that's the only one that I trade. It's just that's my minimum, 50 cents on my delta. But it's going higher because a lot of times I am in the money or a little deeper in the money, depending on what I'm trading. I may have a 60 cents, 70 cents, maybe a little bit higher, just depends. But 50 cents is my core minimum on what my delta would be. What's the longest that you hold your trades? I do leaps. I get everything out from 3, 6 months, 9 months, all the way out. Like right now, I got Netflix leaps for 2027. I have what else do I have? I have, hold on, let me pull it up. Let me go to it real quickly. I have a couple. I have 4 leaps active at this very moment. I have Netflix leaps for 2027 calls. I also have Shop leap for 2027 calls as well. And this is on my Webull, on my Charles Schwab. I have Nvidia and I have Apple leaps over there for 2027. So I mean, the furthest out I go is just whatever game plan I'm working with in the moment. But it's in 3, 6 months, 3, 6, 9 months, 12 months further out. You can go up to at this moment about 2028, depending on the platforms that you use. So that's being a swing trader and a leap trader. You just basically holding your trades for a short window, maybe like a couple of days to a week, a month or so, and further on. And then leaps, of course, you're going to just say a new year. That's all that is. So it's not really like a minimum on that either. I do day trade from time to time, but I do rather hold because I know sometimes the best moves comes when you actually hold your trade. You got some time on your expiration, and you never know what's gonna happen. Anything could happen in a day. Imagine what can happen in a week or a couple of months. So I do like holding for extended. You're welcome. Absolutely. I'm happy this was helpful. And so if this was your first one, go look at the previous one. You'll be able to see that. So that you just kind of go over the bases. And this one's kind of looking at the Greeks. And then we look at the moneyness next week. So that will also show you how that plays into the Greeks on what I just showed you guys and how that changed based on the moneyness. Okay. So now I'm going to be getting up out of here. I do hope this was extremely helpful for you guys on this evening. For those of you who are new, trying to get your feet wet with option trading, and not quite familiar with what those numbers are. I know it's a lot of numbers. I know. But if you just understand the basics, it kind of helps you navigate picking a strike price or just kind of understanding the value and what's going on that chain. So you're not just out here, selecting stuff out willy-nilly. All right. So I will be going live. I'm not sure how many of you guys over here are in the Patreon, but I will be going live in the morning for pre-market live, and then this here is done every Wednesday at 5 p.m. Central Time. So the lessons will kind of stack so that you can kind of add them together to put it all into, kind of get it all in pieces so it's not all rammed in at once. All right. So I'm going to be getting up out of here. If you came in late, the replay will be reposted so that you are able to check this thing out from the beginning if you missed anything, and just be here on time next Wednesday so that you don't miss anything in that beginning when we get that lesson going. All right. So you guys have a amazing, amazing night.